Hello and welcome. It's Thursday morning. You're watching India Market Open. World market still not giving us too much reason to cheer in early trade. It seems like it could be another morning of consolidation, but I think what we should all take heart from is the fact that we've done so much better than the rest of the world yesterday. While world markets sold off significantly, we managed to recover 100 points on the day's low point, respected 25,100. Bulls were in semi-control. I think apart from banks and IT and metals, which are global facing, everything looking locally did okay.
Yeah, low beta markets. We are so low beta relative to the rest of the world. But guys, I thought the really interesting thing, as pointed out by Ridham Desai and team on their note, right? This is big news. They're saying that India is set to become the largest emerging market, overtaking China. And yesterday, India has become the largest weighting in the MSCI IMI index. It overtook China yesterday, and it's knocking on the doors of overtaking China in the threshold EM market as well. Yes. This is such big news and such vindication of what Indian markets are now viewed as. We are no longer tracking error, as they say. I mean, we are a serious 2% weightage on the global indices, and at some point of time, flows will have no choice but to come back, despite the fact that right now they may have a relative underweight on India. This is big news.
No, it's huge. It's huge, no doubt. And it also shows you how the outlook towards India has absolutely changed. And by the way, on that note, happy Teachers' Day, guys, and to all of our viewers. And the reason that I bring it up is that I think there is no better teacher than what happens in the market. The kind of life lessons I think people get every day when they look at their portfolios. Don't believe the first thing that you hear. Do a deep dive in everything that you bet on. So a lot of lessons there. So much to unpack today on what is going to be an exciting day. We have a global view for you also on a day that Morgan Stanley note is out. But let me take you through what has been happening overnight around the world. And let's start with US markets, which had a sort of a mixed day of trade. The S&P 500 and the Nasdaq ended with losses. The Dow was slightly up in the green, although. And data. That's all that this week is about, and how the markets respond to data one day or the other. So the set of data that becomes important yesterday was the number for job openings. Now, the slide in that number was a little bit of a surprise to the street, and that's why perhaps a bit of a muted view. Job openings for July came in at 7.6 million, lower than the estimate of 8.1 million. Now, just for context, all through the pandemic, the number of job openings versus the number of people out there to do the jobs was extremely skewed. That was leading to high wage growth, leading to inflation, etc. So that has sort of reversed. It's another marker of a slowing economy and easing inflation. Now, whichever way you want to look at it. The other big data point that everyone is watching out for is the jobless data that will be out Thursday night our time, Thursday morning for US markets as well. And the expectation is that initial claims will come in at 229,000. Now, if it's way off there, then you could see sharp reactions either way. And you're seeing that on bond yields as well. Sharp moves there on bond yields and your inverted yields, etc. But suffice to say, the key takeaway which you need to look at is that the US 10-year has settled at 3.76% and will be very, very vulnerable to all of the data that comes in over the next few days. Crude is the other interesting story, and what a reversal of mood there as well. We've been speaking last couple of days about OPEC Plus increasing output. Now there are reports that they might delay this decision. So you've seen crude sort of bounce back nicely. Brent at the $73 mark. NYMEX up about 0.5% right now. Let's look at Asia, and Asia has opened sort of mixed. Nikkei with the deepest cuts over there, but that too a little over 0.5%, nothing much more. I want to see the implied open for India and see where we are, set to open, and we're looking pretty good this morning, all things considered. A bit of a bounce back, perhaps, after a tepid day. Fund flows have not been much to talk about in terms of how the numbers that came in yesterday. Foreign investors bought 975 crores, domestic investors bought 97 crores. So a decent setup, I would say, globally as far as India is concerned.
Indeed, just a few more asset classes to add on. Of course, you highlighted crude. It's done 11% in a week, so it's actually a very sharp cut, even though it's steadied out this morning. The dollar index is something that stands out for me. They were doing quite well for most part of this year, but in the last couple of weeks, with expectations of a rate cut, which is around the corner, but a smaller than expected rate cut, is what has led the dollar index to give up most of its gains, or pretty much all of its gains that it had seen in the year 2024. What also was slightly surprising is how gold has been moving. You know, we've seen gold move up as a risk-on trade in the last few months. We'd have imagined that with some concerns of a global recession or a US recession over the last few days, gold would have seen some buying, but it's been 4 straight days of losses coming in for gold. Now, what traders and analysts are attributing that to is the fact that the Fed will cut lesser than what is, or rather what the markets may or may not like. The expectation is 59% of the Fed rate futures indicate to a 25 basis point rate cut. I'm not sure whether that's enough reason for gold to see some weakness, but one more factor that led to weakness in gold prices was the fact that because equity markets sold off, there were margin calls on gold, due to which gold consolidated. But broader trend on gold remains positive. Ferrous and non-ferrous metals on the other side continue to remain weak. Crude is sub $70 a barrel. All that is good news for India, and it seems like implied Nifty as well as indicating to a marginally higher start. A quick take on what happened yesterday before we set up ourselves for this morning. It's looking very solid, and this is largely because of the way we ended in trade yesterday. The markets did a sharp recovery, and if you look at the chart, it was actually quite nice if you were a bull on the street. I think the only question we were trying to understand from most of our analysts yesterday is that should the dip, even though it was shallow yesterday, get bought into? The hope was 25,100 would be defended, but we shut almost at 25,200. Well, what stood out in trade? We did break the 14-day winning streak, but it wasn't too bad, to say the least. The decline was not half as significant as other world markets witnessed. So from Asia to the US markets, it sold off, but we actually held our own. 25,100 was respected, like I said. The US markets led to IT stocks selling off in India. Some may warrant it as profit taking after a very sharp run on IT counters. Metals, on the other hand, also weakened on back of demand concerns in China. What helped our markets was anything domestic facing, so consumption did okay, paint stocks did okay, OMCs did okay, lubricant stocks did well as well. So all that was good, but Bank Nifty, of course, Niraj, we did okay on Tuesday. Had some gains between Monday and Tuesday, but yesterday gave up pretty much all of it. So status quo on Bank Nifty, and it's not like, while we were hoping that there's a catch-up on Bank Nifty in September, it's still been very volatile so far.
Yeah, I mean, the credit growth probably dead giveaway. I know Vetri Subramanian was saying that they've launched a private bank ETF, but the credit growth numbers don't look good at all. But I don't know, I'm just celebrating. Sorry?
If you've got to play the domestic theme one way or the other, there's no way you can avoid banks. I mean, it's the only short way of playing the India story, right?
Yeah, very likely. But I think this argument has been made for such a long time now.
Yeah.
And yesterday,
the banks themselves have to be profitable as well.
But yesterday, I think now people are getting tired as well. I was reading an article which said that Quant Mutual Fund is probably now cutting its exposure to HDFC Bank.
I did read that.
But you know, I just
so
thought,
patience is not a virtue in these markets.
At least for banks, it hasn't turned out to be. Maybe for defense, it has. But you know, just low beta versus Asia and EM peers, and that's such a big balm for anybody who wants to trade in markets, because if the index is steady, it doesn't matter if it's not gaining as much when the other markets are gaining, but you get to bet on stocks in a reasonably good fashion. And I think that's what happened yesterday, right? Because on a day when Nasdaq was down 3%, Asia was down, Indian defense and some of the other stocks really shot up in trade because Indian markets were a lot more defensive. Somehow just continue to believe that long positioning still has some more merit before we kind of peak out on the trading side. So it's been a stance that we maintained yesterday as well. I do think that might happen. And OMCs somehow remain just a safe bet with crude price behavior. Yesterday was the MK, today there's Axis Cap, all of which have come out with notes citing how the marketing margins and the gains for these stocks are so high. We'll get to that in a moment, a bit later on in the stocks to watch segment, but watch out for OMCs. And maybe incremental upsides in expensive stocks may see profit booking. And you know, guys, I just saw this note from Pankaj Tibrewal of Ikigai. He's pointed this out, and I didn't know about this. I mean, in terms of numbers, he says that market capitalization of the defense and railways sector is 18 lakh crores. In FY19, it was 1.2 lakh crores. So that implies that the market cap CAGR of these two has been 67% versus a profit CAGR of 21%. Serious re-rating has happened. So don't know how much long can it last.
That I think is the biggest question right now. So you saw defense revving up yesterday quite strongly. Will that momentum continue? I mean, today looking at the implied open, perhaps you're going to see a more all-round kind of a bull rally, or at least the bulls are going to come out roaring, and in large part perhaps because of that Morgan Stanley note, and I think that's on top of your trade setup.
Yeah, I mean, so that's it. I mean, so now that, post, essentially what I think just this, that what Ridham Desai and team are saying, that 2 or 3 things amongst them, that it's not, India no longer a tracking error. So that is great. And the fact that if we are indeed becoming the highest EM in due course of time, at some point of time it will start reflecting inflows when the rate cuts happen.
It's a structural bull market, like they call it. Just very quickly, what we also saw in pharma yesterday, I think, stood out for me. I don't know whether the gains could continue to roll into trade today, but that's one space to track. Track what happens in steel. So commodities may also get a little bit of a rebound on back of what's happening locally. But let's highlight for you the big stocks that we're tracking in early trade. Remember, you've got an important listing as well. Raymond Lifestyle will list on the exchanges today, so all eyes will be on this one. But just before we go into Raymond, we'll of course elaborate on that a little bit more down the show. The few names that I have on my list is Sona BLW. Now this one has been a buzzer in trade all through last week. In fact, if you look at the 1 week performance of Sona BLW, you'll see the kind of performance it's managed to pull out. A couple of reasons of why it's doing well. They've opened a QIP and set a floor price of 699 rupees. This is at a discount, and they've said that their company holds the discretion to offer a discount of not more than 5% to the floor price that's been calculated for the issue. The QIP price is also at a 3% discount to yesterday's close. What you also want to keep in mind, which might be another big positive for Sona BLW, is that they've received clarification and a certification for another product, the hub wheel motor, for electric two-wheelers under the PLI scheme. So 2 big positives in Sona BLW. This counter could be one you want to track in early minutes of trade on the upside. GIC, this is of course known, but they've extended the oversubscription option in the offer for sale, which will kick off today. The OFS was subscribed 1.08 times yesterday by non-retail investors, and of course what we will be expecting today is an extension of the option to oversubscribe to this issue. I've got another one, and this may not be a stock in news because there's some news coming in on it, but I want to point out Ecos Mobility. You know, yesterday we talked about how the grey market premium was indicating to a 45% upside, but because of the market sentiment, it got a gap up at 17%. But as the sentiment improved on the street, the stock actually did quite well and went home at its day's high point with a 32% gain. The reason I bring this up is because you've got very solid institutions that have come in to the stock in yesterday's trade and picked up the counter on listing day. TNTBC, which is a trustee of Nomura India Stock Mother Fund, purchased a significant 3.8% stake in Ecos at an average price of 439. You also had Matthews India that's picked up 2.4% stake. So I would imagine this counter could see some more traction in terms of early trade this morning, and that's largely because you've had some solid hands come in, and unfortunate due to the market sentiment yesterday, it didn't get the response that it was seeking. So there's an opportunistic trade by some of the big guys.
Yeah, let's see if that 1 week mark moves for Ecos as well, where bulk of the investors, at least who got allocations before a fresh listing, exit from there. All right, the first stock on my list today is Kaynes Tech. I mean, the ups and downs on this stock in terms of news flow are quite astonishing, one must say. The latest is that they have clarified on the cabinet announcement for their semiconductor plant in Gujarat. So you have to see this in a sequence of events. The cabinet comes out and says that they have approved semiconductor plants, and Kaynes Tech is, of course, one of them. The company comes out and talks about it. In fact, they spoke with us as well. A whole host of brokerages come out with very, very positive notes, because this is actually a huge upside for Kaynes Tech for their semiconductor plant in Gujarat. Now, the company has come out and said that they've received no formal letter from the government to build the semiconductor unit. Now, does that mean that they haven't received a letter yet? It's in the pipeline. What has happened are some of the questions the market will have today. And whenever there is a bit of a question mark, it's not seen as a positive at all. So expect some turbulence on Keynes Tech. Saturn Credit Care is the other company that I picked out, the other stock I picked out. So this is interesting. This is a way, and let me just explain this in simple terms, a way for the company to raise funds and increase its fundraising base. So they have completed their first pass-through certificate transaction with HSBC India. They raised about 120 crores. That transaction is valued at about 119.2 crores to be exact. And the fact that they have onboarded this with HSBC India could be seen as a positive for Saturn Credit Care. Borosil Renew is the other one. They've acquired 49% stake in a company called CleanMax Prithvi Limited. They've acquired it from CleanMax Enviro, and this will happen in the next 2 months. The reason they've acquired this company is for development and maintenance of a hybrid solar wind power plant of about 16.5 megawatts. So not a big news mover, but yeah, for Borosil Renew, the stock which has been at the forefront of any kind of renewable energy move, and whenever there is a policy push, this stock runs up. This is could be seen as a positive today as well.
Well, some other stocks and a lot of brokerage calls today. By the way, but just keep one thing in mind on Vedanta as well. That could be an interesting one, simply because the long-term rating has been changed higher. So that is one thing to keep in mind. So Vedanta could be an interesting one. There is a note from JP Morgan on Zomato. They have an overweight rating. A target price has been raised to 340 from 208. Now, amongst things that they are saying that the incremental store economics should turn more positive on EBITDA, giving Blinkit the license, quote unquote, to scale faster than peers and current targets. And they say Zomato has created the highest cash EBITDA and FCF profile and growth across the listed consumer internet businesses, which deserves a premium multiple according to JPM. So that is one stock you want to keep in mind because of this note. And we've been harping about oil marketing companies. I think it's important to highlight this. So yesterday you saw MK say that the most obvious and the most powerful investment hypothesis is on OMCs, and there will be blowout results. But today Axis Cap has put some numbers to it, saying that they estimate that OMCs are currently earning a high gross margin on auto fuels of 17.4 rupees per litre on an integrated basis, as against 12 rupees per litre earned in Q1. That's a big bump up that they might be earning according to Axis Cap in Q2, and higher margins due to this crude price decline pose upside risks to their estimates. So watch out for oil marketing companies. HPCL in particular had a big bang day yesterday. Maybe there could be follow through.
Okay, Jeff Dennis joining us now. He's independent emerging markets commentator, and this entire week is going to be to some extent led by global cues as well. So Jeff, great speaking with you here on NDTV Profit. Pleasure as always. Let me start by just getting your take on what I think is perhaps the debate in the US markets right now, 25 basis points or 50 basis points. And it swings depending on which data point comes in on which day. Was wondering what your take is.
I still think it's going to be 25 basis points. Obviously, the jobs data today was very, very weak indeed and could suggest we're moving towards 50 basis points. But I think we'll finally know, probably after the payroll data on Friday, which looks like it's going to be below 200,000. So I think at the moment it's still just marginally in favor of the 25 basis point cut. A cut is certainly going to happen, probably 25. We'll know a little bit more after the payroll data on Friday, but obviously at this point you cannot rule out the possibility that it will be 50.
If the markets do get a 25 basis point rate cut, as you expect, what do you think is going to be the reaction of risk assets? In that sense, I mean, what happens to US equities? What happens to emerging market equities? And maybe we throw in crude and gold as well, because those have been moving in tandem with risk on trade.
I think it depends to a certain extent, not just on the size of the cut, and as you say, let's talk about 25 basis points, but also what the FOMC will say in their minutes, basically, or perhaps I should say, sorry, not their minutes, their statement. And my guess is they're going to lead, whatever they do in a couple of weeks' time, they're going to lead us very much towards the idea that there's going to be a whole series of interest rate cuts. So the 25 basis point cut might be seen as a little disappointing, but at the end of the day, I think you're going to see the Fed talking about multiple interest rate cuts over the next several months. And so I think any short-term disappointment will probably be relatively limited. In short, what's going on here, as your viewers will know, we are at the peak of interest rates in the U.S. They are coming down. We don't know much about the pace. We don't know much about how much they'll go down. But my sense is come third quarter of next year, they'll be in the range of 4%, something like that. And I think that will be enough to sustain long-term further gains in equities, including in emerging markets.
Jeff, you've been optimistic on India for quite some time now. This morning, of course, we wake up to reports from Morgan Stanley that India's weightage on the emerging market index has taken out China in that sense. When I compare the India-China story, I don't know whether it's fair anymore to make those comparisons because we both seem to be on very, very different roads in that sense. But where is your bias? Are you concerned about Indian valuations like some others are? Or you're comfortable buying into India even at these elevated valuations because we historically have been a high growth, high valuation country?
It's something of a false comparison. I think there's so many other things people can do in emerging markets. The end of August data, shows India at just 20% basically of MSCI EM, and China's at 24.4, something like that. So India's rapidly approaching China. I didn't think it had gone past it yet. I still like the India story. There's always valuation issues, but frankly, these are two countries that are in such a different situation. The Chinese economy is slowing sharply. There are enormous challenges in China, notably, of course, the property sector and the extraordinary unwillingness of the government in China to ease conditions for consumer spending to really pick up and take a bigger share of GDP, which is what you need to get the Chinese economy going. Meanwhile, I think Indian policy is good. The conditions for growth are relatively good. It's always a high valuation market, as you say. So over the long haul, I would still much favor India over China. And ultimately, yes, I think it probably will become a bigger market than China.
Jeff, in terms of, within India as an emerging market, and of course you spoke about how bullish Morgan Stanley, etc., is on India vis-a-vis China, where do you think that you would see global money flow? Would it be the usual suspects, which is your BFSI, IT, etc., or would you look at broader spaces now?
I think it will be the usual suspects. Foreign investors are very kind of staid and traditional in what they do. They look for the places that typically have done well, and they look for the stocks they know. They look for the stocks that are liquid, that are big. And so I think that most of the money will go to the usual suspects. Now, I think as time goes on, of course, the FII data recently has not been so good, but I think over the 12 to 24-month period, I think consumer will look good because the Indian economy will do relatively well. And I think there'll still be some decent upside in banks. But I do think, favored areas like IT and pharma will continue to do well. But I would hope foreign investors will broaden their horizons to other stocks. But I think they typically go very often in emerging markets for the big names, the names they know, unless they can find some really cheap gems. And I'm not sure there's many cheap gems in the Indian market, frankly.
Cheap is being the word that we don't often hear in the Indian markets anymore. But great chatting with you. Thank you very much. We'd love to chat with you longer, but sadly out of time today. Hopefully we'll see you soon.
Thank you very much.
Good morning. Well, it's also one space, and we just talked to Jeff about the India versus China story. Beyond that, of course, it's also Chinese imports that have been bothering India recently. But there is some good news. The Minister of Heavy Industries, H.D. Kumaraswamy, has promised to hike tariffs on Chinese steel imports while speaking at the India Steel Conclave. He said that he will request the Prime Minister and Finance Minister to increase the import duty on steel from 7.5% to 12%. Listen in.
Our friends came and met me. What are all the problems they are facing in this actually growth of our steel industry about the China's issues? I can understand. I will promise you that the problem which you are facing from the China, for that actually I try to convince our Prime Minister and Finance Ministry to look after about the from 7.5% tax to 10 to 12% you are actually giving a demand is there. For that, definitely I am going to try to convince and to bail out the present problem which our steel industry facing in India. For that actually I will be with you. I am very grateful to you for your achievement and the contribution given to the country from your industry. I urge all of you to bring your minds and expertise together so that as one united Indian steel industry, we can forge a path forward.
So while a round of applause there when the minister said that, this is something that he is saying he is going to try and do, speak to the Prime Minister and the Finance Minister about. And then also we need a bit of a reality check of how feasible it will be if import duties on steel are increased, positive for domestic steel companies, but what would be the ripple effects? Aditya Velekere, metal analyst at Axis Securities, joining us for all of that perspective. Aditya, very good morning and great to speak with you today. So first of all, how much do you think this is going to impact steel company prices today or steel stock prices today as a sentiment? Would it be taken very seriously?
Sentimentally, it's a positive step. But if you see at current spot prices, the Indian steel HRC prices are still trading at a premium of 8% at 7.5% customs duty. So if they increase the customs duty to 12%, then the premium drops down to 4%, but it is still not at parity with the Chinese prices. So they will have to raise the customs duty at least to 17 to 18% to get at parity with the Chinese steel prices. So even if they increase to 12%, Indian steel prices will still trade at 4% premium to the Chinese prices. So the real trigger will happen if there is some positive pickup in Chinese steel demand. We expect that as the autumn season picks up and the monsoon gets over, there might be some pickup in industrial machinery and construction activity. But it's still too early to say. We will have to continuously monitor because globally, including US and China, the PMI prints are in the contractory zone. So, but we are hopeful that there might be some relief post this as the autumn season picks up.
So as I understand it, the actual global demand for steel, and especially from China, is a bigger concern than the import duties that we currently have on import of Chinese steel. Having said that, Aditya, just in the context of, if import duties are increased, indeed increased, which are the steel companies which would be most beneficial?
So it will benefit almost all the steel mills because ultimately it will put off the pressure on domestic steel mills to as they compete directly with the Chinese HRC prices. But as I said, the quantum of the customs duty increase from the minister's comment of 10 to 12%, it should be higher. It should be at least up to 18% to get at parity with the Chinese prices. So that's point number one. But the root cause ultimately will be decided by the Chinese steel prices and the demand in China domestically. Because if that doesn't pick up and China continues to dump and export higher steel, in the first 7 months of this calendar year, they have already exported 60 million tons of steel, and in calendar year 24, there are expectations that these steel exports from China will touch 100 million ton, which will be the highest figure since 2016. So ultimately, there should be some pickup in activity from China, which we are looking as a positive trigger for this steel sector. If it doesn't play out and the demand from China continues to remain subdued, then the impact, the pressure on the domestic steel mills will persist.
Aditya, just a couple of other factors that stand out. Indian companies have lower leverage than Chinese steel companies as per Moody's report. Raw material prices for steel companies have been reducing. We also understand that JSW Steel has hiked prices from 750 to 1,000 rupees per ton. And we're concerned about Chinese dumping, right? Keeping all those factors in mind, where are Indian companies getting the confidence to hike prices because margins have improved? And secondly, also, while there's all this talk about double-digit growth, in your pecking order, which are the top 3 companies that could benefit on back of lower leverage and better margins and price hikes?
So as far as steel stocks are concerned, we are still slightly positive on non-integrated players like JSPL and JSW Steel. We are slightly negative on Tata Steel and SAIL. Tata Steel has multiple issues with respect to their UK asset restructuring. They have a long road ahead in order to restructure the UK assets. SAIL is structurally cost sensitive and price sensitive company, so we are slightly negative on SAIL. Also, its history with respect to its capex management and modernization program is not very good, and they have exceeded their previous expectations of capex in order to increase their steel production. So we think the drop in the raw material prices like coking coal and iron ore, that will be slightly beneficial for the non-integrated steel players. The drop in HRC prices definitely gets some partially offset by this drop in coking coal and iron ore prices. But still, in the second quarter 2 of this fiscal, we expect that the steel spot spreads will be slightly under pressure on a quarter-on-quarter basis, maybe 1 or 3%. On a year-on-year basis, a rough calculation says that the steel spot spreads will be in the range of $350 to $360 per ton from the last year's $450 to $460 per ton. So that is the quantum of impact because of the fall in the HRC prices.
Thank you, Aditya. Great chatting with you this morning, and thank you for sharing with us your top recommendations and steel stocks that you actually like in this space. Aditya believes that an increase in import duty is not enough to offset the dumping from China in the markets. Let's not also forget that JSPL recently, through our channel checks, we understand has hiked prices from 750 to 1,000. Margins have also improved, and Indian companies are better managed and have lower leverage. But what we really need is global growth to pick up. So that's the word coming in. JSPL, Tata Steel and SAIL are the 3 stocks that Aditya is constructive on. Well, talking about China and keeping our eyes on the ground, we believe India has beaten China with its largest weight in the MSCI Emerging Market Index. Morgan Stanley says that India remains their top pick and expects the correction to be shallow. Richa has more details on this. Richa, I believe Morgan Stanley is of the opinion that India is in a structural bull run and any correction we get will be shallow and, of course, get bought into from the look of it.
You're right, Samina. Good morning. So I'll start with India, which has become the largest emerging market in the MSCI Emerging Market Investable Market Index, which is the MSCI EMIM Index. Now, in the August review, India was just a few points away from China to back this position. And yesterday, India took over China to become the largest emerging market country. Now, Morgan Stanley looks at this from 2 sides, the good side and the bad side. Talking about the good side, rising weight, of course, means more absolute foreign flows, but it also believes that the money is waiting outside India and foreign investors essentially are waiting for a correction to happen in India. But the problem which these foreign investors are facing is that any bit of correction in the Indian market is attracting domestic flows, and therefore domestic flows are outbidding the foreign flows. The other good side also is that India is gaining share in the global GDP as well as the global market. Talking about the bad side, the brokerage house believes that the correction in a strong bull market is highly likely. It came out with a note even yesterday wherein it mentioned that the sources of correction are always there on the side of such a bull market run. And it also said that China's performance did suffer after it became the largest emerging market country. However, if we look at this through India's angle, India's bull run is largely backed by fundamental factors, and hence it believes that India's newfound position in the emerging market market is not a worry. So, Samina, essentially the bad side is not actually a bad one, which the brokerage house has pointed out.
Rucha, coming to the details of what exactly does Morgan Stanley really like?
Tamanna, Morgan Stanley's top pick is India because India has outperformed. The Nifty index has outperformed the MSCI emerging market index in the last 3 months, wherein Nifty gave around 8.5% and MSCI just gave around 5.5% of returns in the last 3 months. Talking about corrections, it believes that corrections would be very shallow, and even a small bit of correction, as I rightly mentioned, would drive money which is there already on the sidelines back into the markets. Now talking about the bull market room, right? It believes that a bull market is still possible in the future, and India's weight in the emerging market index could have some more room before it peaks out. This is what the brokerage house believes, even after today, wherein India took over this emerging market position from China yesterday.
Okay. Well, Rucha, thanks a lot for that. So corrective move could happen. I think so. A lot of things highlighted so well. There's something that I tweeted out which I thought was also very interesting from the Morgan Stanley note just before we go to Agam. They say that we look at China's history to learn something from likely prospective behavior. So when China became the largest EM weight in October 2008, it had a relative underperformance for some time, but then it recouped all of that, and the peaking only happened in 2020. So even if post becoming the largest investor, if there are outflows, and there are some outflows from India, because of this domestic behavior, I don't think we'll suffer as much as China did in that ensuing period. Remember, 2008 was also the post-GFC period, so there were also other things factored in it. But these things, once you become a largest EM, take a really long time before they peak out. So I think we might just be getting started on this holy grail. Will be really interesting to see how this shapes up.
Yeah, but don't expect the path to be just lined with roses, petals, and flying over a rainbow. Some bumps across the road, and some you could see on the derivative side today as well. Agam, what's the picture looking like?
Well, it's not a bad picture, to be honest, because yesterday we were fairly resilient to the kind of volatility that we saw across the globe. And while we did see cuts, the cuts were not as sharp as what we were estimating earlier on in the session. So let's start by taking a look at the Nifty as usual. And that is where, once again, you have seen a little bit of weakness. We've snapped a very, very long, gaining streak. In fact, the longest in decades, perhaps. And that said, we just saw a cut of around a little over 0.25%. So certainly not a bad day of trade yesterday. About 1% added in open interest. The Bank Nifty as well is where we've seen about a 0.5% cut, but we're still holding on to 51,000. Again, potentially good. But it's going to be a wait and watch. There's plenty more to come through the course of the next few weeks for the Bank Nifty. And as far as the option market is concerned, today is that weekly options expiry. And what we are looking at is a relatively strong base being built at around 25,000. That's also where we have a substantial amount of puts being written. And on the higher end, we're not too far away from the call strike, which has the most amount of open interest. That's the 25,300 call. But I'd reckon that the range would be more between 25,300 and 25,500. That's where we may see a little bit of resistance as far as the Nifty is concerned. Of course, given the fact that 23,300 does have a lot of calls, and should we see strength and should we see the Nifty consistently trade about that level, you'll start seeing a lot of unwinding in those calls, and that could potentially move the Nifty even higher. As far as stocks are concerned, again, it was a mixed day of trade yesterday. Max Financial, Berger Paints, and JK Cement among stocks which actually did see longs building in. And among stocks which saw unwinding, we saw about a short covering for GNFC and Deepak Nitrite. On the other hand, Gujarat Gas, Crompton Greaves, and ICICI Bank looking at long unwinding. But let's take this conversation forward with Rahul Ghosh of Hedge.in, who can perhaps help us decipher further as to how we can move around these markets. Rahul, good morning. Thank you so much for joining in. What's the way forward now at this point in time?
Thank you. Good morning. And like I said, thank you for having me. As you rightly said, the Nifty range is slightly tight, 23,300, which is on the upside. It's giving a small tinge of upside bias. even though the calls are written looking purely at the gap up of 100 odd points that is currently being said. If you look at the Bank Nifty data for today and for the future expiries, you will notice that below 51,400, there are some quantity of puts being written which are sizable in nature. Now, keeping this in mind, we need to be careful that although we keep with the long bias, we need to be very cautious on the long side. And the view would be cautiously long looking at the next week or two. And when you're cautiously long, the best strategy to play out in these situations is a pure play butterfly. Same expiries in this case, because if your direction is not very clearly known and you have puts written on one index and calls written on the other index, this proves to be a good way to do things.
All right, Rahul, based on that, how are you going about? What kind of option structure are you deploying here?
So we're planning a simple call butterfly using the 12th September expiry, which is the next weekly expiry for Bank Nifty. What we're doing is we're buying the 51,600 call option. We're selling 2 lots of the 51,900 call option, and we're buying the 52,000 call option. Now, if you look at the net debit in this trade, minusing and adding all the premiums, you will notice that the net debit is only rupees 1250. So in case Bank Nifty does not go beyond 51,600, which is about only 0.5% above of current market price, then the maximum loss will be 1,250 rupees. This maximum loss can be further brought down by rolling down the 51,900 to maybe a 51,800 or a 51,700 only when Nifty goes, only when Bank Nifty goes below the 50,900 mark. Mind you, below it closing below 50,900, this modification should not done. The advantage of planning a structure this way is that if Nifty remains sideways, you still don't lose any money. If Nifty goes up little bit, Bank Nifty stays sideways, you don't lose money on it. But if Bank Nifty goes up sharply or goes up slowly, you tend to profit in both scenarios.
Right. There you have it. That's the butterfly that Rahul is looking to play as far as the Bank Nifty is concerned. And that, of course, involves, the central point at that point in time. It's about 51,900. But Rahul, on that note, thanking you for joining us and taking us through your view on the market and, of course, giving us that option structure on the Bank Nifty. But don't forget that we are taking up your futures and options queries as well in the FNO show at 10:30 today. So don't forget to post them up and WhatsApp your queries to the number which is being flashed for you on your screen there. That's what we have in terms of the futures and options space. With that, it's back to you all.
But there's another story we want to come to you on, Agam, which is the Adani Enterprises maiden bond issuance, which is now looking at individual investors. So there's a sizable book for individual investors, retail investors, which has opened for subscription. Tell us more about it.
Right, so Adani Enterprises has opened up subscription for the issuance of secured non-convertible debentures. This particular issuance is worth 800 crores, cumulatively, and this will involve 400 crores as the base issue. And in case of oversubscription, which is a higher probability, well, there will be an additional 400 crores which will go out and open up for subscription. As far as, your interest rates are concerned, the effective yield on these bonds will go anywhere, will get you anywhere between 9.25 to 9.9%, depending on the tenure. And well, moving in, as far as the ratings are concerned, these NCDs have been rated CARE A+, and this is a single A+, and CARE Ratings has assigned an outlook as positive. This issuance also provides a security cover of around 1.1 times, and of course, it's the issue opened yesterday, and it will remain open all the way through 17th of September. So plenty of time to go ahead and subscribe. And that's what we have in terms of Adani Enterprises maiden bond issuance.
Thanks, Agam, for that. This one's a big one, so watch out for this. Keep it on your watch list. And a bunch of other counters that we'll be tracking in today's day of trade. We've already taken you a few that we do think are going to be important. But just to add to that list, you've also got a few more to track. REC on top, recall, they've talked about doubling their AUM to 4 lakh crores, green plans by 2030. TARC, the stock is up 11% in the last 5 days. Remember, it's a multi-bagger, and they've seen registration for TARC Ishwa project. Sona BLW, an approval on a PLI scheme and a QIP price that has been fixed at 699 rupees. You've also got Vedanta after 2 successful fundraisers. ICRA has improved or upgraded their rating to AA from AA-. Suzlon, keep this one on your radar. Conveyanced deed for One Earth property for 5 years. It's a reverse lease that, of course, Suzlon is picking up.
Okay. Some more stocks. Century Textiles, the Hindalco land guarantee, and coupled with the fact that Century is bagging a lot of other land parcels, could be interesting. Ganesha Ecosphere, a recycling stock, hot in focus. JV with Race Eco for setting up washing plants for pet flakes. So watch out for that one. Prestige is just an approval for a QIP, but you never know. The stock was very active yesterday, so watch out for this one today. And Zaggle Prepaid is in pact with Blue Star. So one more company for employee expense management contract for Zaggle may be active today.
On the not so great news side, Keynes Tech, definitely no formal letter for the semicon business, will be seen as a bit of a negative perhaps. GIC has extended and utilized their oversubscription option to about 3.68%. Remember, the stock was already down yesterday with that stake sale, so that might add a bit more pressure today. So those are some of the stocks that should be on your watch list today. But Nirav Shah joining us now. He is head equity research analyst, Latin Manharlal Securities. Nirav, very good morning to you and great to have you on the show as always. Now, just look at the implied open this morning, and we're looking like we're set for a good start. Maybe a whole set of factors, maybe that Morgan Stanley note has also boosted sentiment. But where do you see the most upside coming in, Nirav? Will it be some of the laggards which haven't really moved so far, like the banks and the autos as well, which have been quite quiet?
Yeah, good morning and thank you for having me on your show. As you rightly pointed out, I think markets have shown a lot of resilience. And even yesterday, when there was a bit of turmoil in the global markets, we've seen the domestic markets hold out quite well. One of the important factors which is going to influence the markets is the sharp fall in the crude oil prices. So I think this augurs extremely well for various sectors like paints, tires, plastic, chemicals, petrochemicals, aviation sector, etc. And I think we are likely to see a positive effect of this even on the FMCG sector. Yesterday, if you recall, HUL has hit a 52-week high. So it's a benefit which arises on account of the comeback in the rural demand, the lowering of the crude oil prices, because 51% of their portfolio is soaps and detergents. So I think that could have a positive bearing over there. And overall, I think auto sector, if one were to look at the auto sector, then I think the two-wheeler space still looks quite attractive, despite the fact that most of the two-wheeler stocks have doubled in the last 1 year. Apart from this, I think IT space has been holding out quite well, despite the fact that the global scenario continues to be a bit volatile. And we have banks which continue to be the sore point as far as the markets are concerned.
We have with us Shrikant Chauhan as well of Kotak Securities, joining in with his view on the markets. Shrikant, yesterday the index looked nervous, but by the time we closed shop, we closed just shy of 25,200. I mean, it's almost compelling to go long on the index. Would you agree with me, or would you still be circumspect and avoid any long trades on the Nifty for now?
Good morning, Samina. Good morning, everyone. I think, markets are like going to consolidate at higher levels. Even if we go through with the trend of last 10, 12 days, then it was going up gradually. There was hardly any major gains on a day-to-day basis that we saw. Yes, eventually, like in 10 days, we saw the markets crossing the level of 25,000. But otherwise, the market was more towards stock-specific activity. And I think now the way there are developments, the 10-year bond yield is quoting above the levels of 2-year bond yield. It's certainly not positive for equities. That means that we can see some recessionary sort of activity in the US market, at least in the short term. So that will actually going to keep pressure on the equities. And that's the reason I'm of the view that till the markets are not crossing 25,350, which is the highest high level of Nifty, I think we are going to see sideways sort of activity in this market. As it's a weekly expiry day, if we see the market is crossing 25,350, then there is a possibility that we could see some more short covering. Otherwise, I'm of the view that we need to be more and more stock specific. In fact, we should look for taking some profit on long positions or reducing long positions if the markets are really opening with a gap of 100 points.
And if it is going to be a range-bound market, it's going to be all about individual stocks, right? So if you're going to avoid the index, what are the individual top trades that you're recommending to our viewers this morning?
Yeah, I think so, there are a number of stocks which are really doing well. They are very close to their important breakout levels. Most of these stocks are crossing their levels, and after crossing that particular level, we are seeing good amount of activity. So yes, there is buying interest in stocks, in specific stocks. In that, we like Grasim, which is currently around some 27.50, 55. There, I'm expecting stock to move towards 28.50, 29.50 in next few days. It's a positional call because it is very close to its important support levels. At the same time, I'm not expecting any major firework in the market. So it's a positional buy with a stop loss at 26.40. We can expect 28.50, 29.50 on the high side on Grasim. The other stock which we like is Biocon, and almost 3 months the stock was below the levels of 375. Whenever we saw the levels of 375, we saw some good amount of profit taking, and all the way the stock came back to the levels of 330. But yesterday's trading session clearly indicates that something is really going positive for the stock. It has managed to cross the level of 375, it closed about the same. So based on its technical formation, I am expecting stock to move towards 415. And we can keep a stop loss around 365 for buying Biocon at current levels.
Shrikant, let's look at some of the big movers over the last couple of days, and largely I think on technicals. And I want to just pull up Godrej Industries and your view there, because no real fundamental reason. I think it's moving on the charts and has been seen quite a bit of an upside. Let's see yesterday's chart, the intraday chart over a month, still fairly good. Do you think that there is more steam left here?
See, Tamanna, I think I cannot give my comments on Godrej, entire Godrej Group, because all these Godrej stocks are in compliance list. So I cannot share my views.
No issues. What about Keynes Tech? Is that something you're tracking and can talk about?
Yeah, absolutely. This particular stock is showing a lot of momentum, and it is just on the verge of crossing all important levels. Whenever the stock is correcting, it is finding support at important levels. This time also, after hitting the levels of 4,600 levels, it recovered sharply. And it was some 20-day simple moving average, which was actually supporting to the stock. So what it means that whenever there is a correction, someone is there to take buying interest or to invest in this particular stock because it is crossing its previous high. So this time also, I think around 4880, 4900 levels, it's a buy with a stop loss close to 4600. I'm expecting stock to move towards at least 5200. But in the medium to long term, this stock can be around 6000 levels.
6,000. By the way, the beauty about stocks like Keynes Tech is that at 2,500, it was trading at a P multiple of 90. People found it expensive, and it went on, earned earnings, but has become even more expensive. The TTM must be at least 120, 130. But some of these stocks are growing at such a good clip that people are not seeing any reason to be negative out there. Okay, Niraj, some of the, yesterday we saw a note from Morgan Stanley on how some of the chemical names have actually now disappointed with their earnings, and the upgrades are some time away. So sure, agrochem may be growing, but some of the others, they specifically highlighted Aarti, which they thought is missing a point or two, or maybe the dyes and pigment segment is not doing well. What about this bucket? People had started getting constructive there. Is there anything you like here, or are you taking money off the table?
No, at least at this point of time, I think the recovery is some time away, and most of these companies have indicated that they expect recovery from the second half, after the second half of the current year. So I think one should start looking at numbers from Q3 onwards, whether there is a signal of recovery. Having said that, I think we have not done any meaningful buying as such, but we do hold positions in a few stocks like Sudarshan Chemicals, etc., which we'll continue to hold and maybe see how things pan out Q3 onwards.
Sudarshan Chemicals, in fact, that's been in the news yesterday as well. The stock looking good with the 5% up move that we saw on trade. Well, another space, Nida, when you want to comment on this one for me, IT saw some profit taking yesterday. Some may argue because it's what happened on Wall Street in overnight trade. Others believe it could be healthy profit taking after the recent rally. Incremental money, would you still look at adding into IT stocks? And if yes, which ones would those be?
Well, not at the moment, but I think IT stocks have seen a very good run up. So if one were to take into account stocks like Infosys, it's gone up by around 38% in the last 3 months. We've seen HCL Technologies up by around 36% in the last 3 months. TCS up by around 20% in the last 3 months. So I think it's a good opportunity to take some profit, to do some profit booking and maybe enter. This is not the right time to enter, at least wait and watch would be the approach.
Shrikant, just wanted your take on a few of the buzzers yesterday and one or two which might move today as well. Let's start with Mazgaon Dock and some of those defense names. Do you see a further upside? Mazgaon Docks was up over 7% yesterday. So what do you think about that? And let me add a Zomato for you. Zomato has already seen a slew of upgrades, very positive notes from across the scheme of brokerage houses. JP Morgan has now joined the list. Do you see that potential in the charts today, Shrikant?
Yeah, I think like after correcting for almost 2.5 months, all these defense related stocks are very close to their important support levels. And they are again rebounding from those levels. In fact, the rebound is much better than the expectations. Delivery-based volumes, daily turnover is also increasing, which clearly indicates that all these stocks have now again started pullback rally to their previous sell-off that we saw. Like Mazgaon Dock was around 5,800 levels. From there, all the way it fall to 4,200 levels, and now again it is rebounding. So we can see some at least 5 to 10% sort of activity in the near term for all these defense stocks. I'm not expecting all these stocks to cross their previous high. It is very difficult because the way they have fallen, I think they are going to take some more time to cross their previous highs. But yes, we are going to see some volatile activity and some range bound sort of activity in a very broader range. So for Mazgaon Dock, our target is around 5,400 based on its technical formation. We also like Hindustan Aeronautics, which is around 4,850, 4,900 levels. But there also the stock can move to the levels of at least 5,300 or 5,400 as compared to its previous high of 56, 5,700. So these two stocks are really showing a good amount of strength in this market. And for specifically Zomato, yes, it is correcting from the highs. Now the news flow is almost over. So we could see some more weakness in the near term, maybe 230, 35 sort of levels we can see on the downside. But otherwise, the broader trend of the stock is very strong, and at least in next maybe few months, we can see the levels of 270 or 275. So in the near term, I'm not expecting any major activity. But yes, if there is any furthermore correction, or even at current levels, if there is a medium to long term view, then look for taking long positions.
All right, time for a short break. We'll be right back with the pre-open session. Remember, we are likely to start off over 100 points in the green. Stay tuned. We'll be right back.
an exciting morning. It's going to be an exciting morning because of a whole host of factors, but also we're expecting Indian markets to buck global trends where there is a bit of meandering. Remember, Indian markets have been quite range-bound last couple of sessions, but will we start strong and stay strong this morning is the big question. First pre-open rates hitting on your screens, and of course we'll wait for them to settle and see what kind of a day we're in for. Are we going to see more stock specific action, or are we going to see a broader kind of move? But we have with us today Atul Suri, CEO of Marathon Trends PMS. Atul, great to speak with you here on NDTV Profit, and good day to speak with you as well when there is such a bullish outlook that has come from Morgan Stanley vis-a-vis India. India has topped China on the MSCI EMI index. Just wanted to get your thoughts at a time when the question and the refrain is, are we overvalued? Is the bull run overstretched?
See, that has been a worry for the last few months, and the market continues to surprise on the upside. In fact, what you will notice is that even when globally markets correct, India corrects less. Let's take the last month only, when we had this whole yen carry trade issue. The Japanese market swung 26%, the US was down 9.5%, India at best fell 4.5%. So what happens is that India is showing immense downside resilience. Not only is it going up faster or breaking out early, it is also showing immense downside resilience. And I place a lot more emphasis on downside resilience. In a bull market, an up-moving trend, sometimes froth can be faster or can rise higher. But when markets correct, as I saw last month and I discussed of this yen carry trade, India fell less. So I don't feel that it is all frothy. We have immense strength at lower levels. And after this Morgan Stanley report, what you'll realize is that, okay, it's not going to result in FI flows immediately, but the case for India becomes stronger. The case for ignoring India for far too long also becomes less. And just as the FIs feel valuations have run up or India is expensive, but as and when India corrects, we know that apart from domestics, we also have this very large FI flows which are waiting to be deployed. The important part of reports like this is that you cannot be ignored for far too long. As an economy, we've already, knocking at the top three. And as a market also, I think we'll have to get used to surmounting many such hurdles and benchmarks and accept it. And the only thing is that trying to find the top and finding it's overvalued, is something which I have rarely found people get it right. As the line goes that more money is spent waiting for a correction rather than a correction itself. And I have seen people waiting for the last 6 months, and maybe they may have to wait for next few months also.
Atul, morning, Niraj here. So whether we become the large EM in a month's time, 2 months' time or longer, I think you made a very important point about how India can't be ignored. The contra that people might say, oh, the most expensive EM, how can money come in? But we are looking at a rate easing cycle in the US, which typically leads to flows into emerging markets. You think despite the valuations, both passive and active flows, coupled with the fact that if we become the highest EM, that will also draw. So you think, or do you think that we are set for inflows over the course of the next 6 to 12 months from the global investors?
See, Niraj, it's difficult to, guess or give it a time frame because the variables and what they are thinking is tremendous. But what my logic is that, if our weightage in the EMs goes up, even globally, our weightage goes up. When you're a very small market with a decimal allocation, you can be ignored. You can be called a rounding error. But when your allocation becomes a larger number and when you move and the market, the overall index gets reflected or starts getting pushed because of that, you can't be ignored. Let me give you an example. Like in the Indian market, HDFC Bank or Reliance. Now, if HDFC Bank and Reliance start moving and a fund manager is not holding it, they will be forced to buy it simply because they are important components. I'm not saying India is the largest component, but once we become of some size where we cannot be ignored, then by default, whether you like the valuations or no, you will have to allocate. So the important part is that we move away from just a rounding error, a decimal rounding error, to an asset class or an important play. And as I said, that we are going to surmount many such milestones in this journey, and this is just one of them. So immediately it will not result in action, but it cements our overall position of strength globally in markets.
Also, Samina joining in, and you talk about how we are in a long-term structural growth story. In the last 15-20 years, Indian markets have tripled. And of course, looking ahead, there's some nervousness, there's some optimism. Where do you feel the leadership will come from? The last 2 to 3 years have been about broader markets. The large cap space has been conspicuous by its absence. Do you feel the next leg of the rally could come in from the heavyweights, and that also means that the bias of a portfolio should be to large cap names?
Yes, large caps from history are at a disadvantage compared to small caps, and they do pull back. We know that these things happen. But I would look at it from a more interesting observation that I have in recent months. Is that in the last 2-3 months, I feel that leadership in the market is changing. See, the market was dominated by PSU stocks, or you will see that the market was dominated by the capital good engineering. But what I'm noticing in the last 2 to 3 months, that 3 new themes are emerging and very strong. First and foremost is pharma. Pharma is a sector that's been ignored for years, but it's a very large segment. And even if you go and see the new lifetime highs or 52-week highs, you'll find that pharma stocks are pretty much, very much dominating that list. So that gives me a sense that this sector is going to be a good catch-up play. The second sector, which is very important, is IT. Barring the volatility in NASDAQ on a day-to-day basis, but you'll find a lot of IT stocks also reflecting that kind of move. And third is consumption, more on the discretionary side. So I feel that these 3 themes are emerging. It is important that a broader market needs to participate. It cannot be just PSUs and cap goods. These sectors were ignored. They need to do a catch-up. So I think it's very, very important for the overall breadth of the market that more and more sectors participate. These 3 sectors are very big. They're important. They're heavyweight. And I feel that if they do the catch-up, it will be great. And yes, as a summation to that, a lot of large cap stocks are prevalent in these 3 sectors. And that is why you may see that there is also a large cap happening, because there's a fair amount of representation of large cap stocks in these 3 sectors.
I noticed you didn't mention banks. And that is one space that is significant in the large caps. And I know you don't like banks either. So you want to talk to me about what happens to banks and what happens to financials, which are clearly behaving separately.
So the fact is that banks have been my underweight in my PMS for the last some years, and I continue to remain underweight banks. It's very different narrative compared to financials. Now, what I'm noticing is that we club banks and financials in one line or one word, but the fact is that financials are behaving very different from how banks are behaving. And yes, banks will catch up. It's not that they are going to lag the market by a big way. But as a trend investor, my job is to find leadership. And just as I mentioned the 3 sectors earlier, I feel that financials is another great sector. So you look at some of the AMC stocks, some of the broking stocks, some of the insurance stocks, a lot of the NBFCs, they also are breaking to lifetime highs. So in my fund as I'm positioned, I'm underweight banks, but I'm overweight financials. And I think that they are, as I said, termed or clubbed together, but honestly, they're behaving very differently, and they're both giving me different opportunities in the market.
What about the whole play on consumption? Now, rural consumption is set to rebound. There are already green shoots there. But the play so far has been very focused on discretionary consumption. So hence you see, for example, Zomato becoming, the darling of the street, etc. Do you like that kind of a play? Any view on a Zomato and the larger consumption story?
See, I won't speak on specific stocks due to regulation. But as I said, discretionary consumption is standing out. And I think that this is, as I said, we have to get used to it as a country. As the GDP grows, the per capita grows, discretionary consumption will improve. And I think this is again a part of a larger play that is happening. Yes, wherever there is a digital angle in terms of delivery, definitely it will be favored, because as a country we have adopted digitization at the mass level very, very successfully. And I think that this is again one of the many more hurdles that we will overcome, and we just need to get used to it.
Atul, final question from my end really, and that is on themes that have been the center stage of the last 2 or 3 years. Fundamentally, power, for example. Such a powerful rally, targets are very stiff. Is power in the right quadrant in addition to the themes that you just mentioned?
Yes, power is in the right quadrant, and I feel that some of the alternative energies, renewables, are still looking very good in spite of having run up. And the fact is that, I mentioned PSUs, whether it's defense stocks, power, energy. It's not that the story is turned. It's just that they need to rest. They've run very hard, contrary to everyone's expectations for the last 2.5 years. As a runner, you cannot be leading the pack all through. You need to conserve your energy. You need to run the marathon. So I feel that these are ultimately the marathon stocks. But they need to rest. They need to conserve energy. And the rest of the field does catch up. So I feel that it is nothing but the broadening of the market. And that is very, very important, because if the market is standing on just 1 or 2 legs, it can fall very badly when those legs give up. When the legs get more, the run can be longer. So what I'm happy about is the broadening of the sectorial breadth, which means that this rally has more legs. That means that this marathon has a lot more distance to cover.
Marathon analogy. Auto stocks in this marathon, are they zooming? Do you see Usain Bolt speed, or are they going to be slow and steady?
I think that they have done very well, and there will be some that will stand out. I think that the themes are a little more divergent at the moment. Not all auto stocks give you that level of confidence. Some do. So I think that the screen tells you where there is strength and where there is weakness. So it's not an across the board for autos, but selectively some still continue to perform and do very well.
Okay, thank you. Always a pleasure to speak with you, Atul Suri, there on all of the fact that India is set to become the largest emerging market, that Morgan Stanley note, and of course all things Indian markets. Harsh joining us now. Harsh, we're very short on time. Very quickly, what is JP Morgan saying on Zomato?
340 target price, 40% upside. First off, very ambitious plans, especially on the quick commerce side of things. 1,500 stores to be opened in 2.5 years. Incremental store economics will continue to improve, giving Zomato a bit of a leg up when it comes to quick commerce. The upgrade that they've done to the GOV, which is the gross order value for the quick commerce segment of Zomato, is 21 to 40% over FY 26 to 27. EBITDA upgrades also in the almost 90 to 120% band, and therefore quick commerce as a business, what they've done is they've hiked the target, or rather the price or SOTP valuation of that, by 115%. Now per share value of quick commerce at 150 rupees a share. Quickly switching to food delivery, business model has matured according to them. Medium term growth guidance has, or rather the expectation has been lifted from 15% to 20%. GOV lifted by 5 to 11%. EBITDA lifted by 10 to 11% odd, and therefore valuations lifted by 36% for food delivery. Going out, they believe that dine out, Zomato has done very well, and therefore events also they will likely do very, very well. Positive 40% upside.
Not for that, Harsh. Zomato 2% higher in trade. Shrikant Chauhan, quick word on Zomato.
Yeah, I think in the near term, we can see some more corrective sort of trend in this particular stock. I'm not expecting stock to rally very quickly, but yes, in the long run, certainly we are expecting stock to cross its previous high of 270, and maybe we can even see the levels of 300. So the overall long-term trend of the stock is very strong. But in the near term, I think because of lack of triggers, the stock can show some sideways sort of activity.
Quick word, Shrikant, on AU Small Finance Bank.
Yeah, I think there we are seeing some buying interest, especially whenever there is a fall in the stock, and it is very close to its breakout level at 700. So if we see the stock start sustaining above 700, then we can even see the levels of maybe 745, 750. But broadly, this stock is like very, very choppy. It is finding a lot of difficulties to sustain at higher levels. So we need to be careful if we see the stock is moving towards 800 levels. But at these levels, yes, it is very close to the breakout level, and we can see some breakout sort of activity in the stock.
Okay. Stay on, gentlemen. Nirav, please stay on. We'd love to talk about a couple of fundamental things before we let you go. But 20 seconds left for the markets to kickstart trade. Not starting as strongly as the implied open may have suggested. but starting off in the green nevertheless. The question only is, what do we do from there? Do the heavyweights contribute, or is it yesterday's winners in some of the crude beneficiaries which still remain center stage, the paints, the OMCs of the world? We'll find out in just moments from now. Here come the first rates, about 44 odd points, so not 35 actually, just a nothing kind of a start really. And banks are actually doing slightly better. They did better yesterday as well. Remember, Bank Nifty did okay. IT was the big sulker, and I wonder if Nifty IT is starting off in the red again. No, just about 0.25%. So actually the heavyweights are doing well. Maybe the others aren't. Quickly, just the mid-cap and the small-cap indices before we go to the heat map, because I'd love to see what is underperforming. Mid-caps about 0.4, small caps 0.5%. Let's get the heat map. Want to see what's in the red, because IT and banks are not. Well, it's a clutch of stocks really, but yeah, maybe some FMCG names just taking a bit of a backseat. Britannia, Nestle, HUL feature in that list. What's doing well, therefore, again, not a very large list, but remember, yesterday we spoke about how cement started to see some buying. Ultratech top gainer today. Hindalco has some gains. Wipro bounces back a little bit. Metals like Tata Steel and Hindalco doing okay for themselves. Reliance in the green, but almost a broadly spread day. Not too much to talk about in the large caps, unfortunately, Tamanna, except for the fact that FMCG seems to be sulking just a little bit.
Yeah, it's a so-so kind of day, and some upside maybe on the steel side, sentimentally more than anything, after the Union Minister's comments that they would look perhaps at increasing import duties on steel imports from China. But let's look at stock-specific action that we could see today. I just want to look at if we are seeing any impact on the crude rebound. Remember, that was the big story in yesterday's trade as well. So let me pull up Oil India and ONGC. They were big losers yesterday, a bit of rebound for them. On the other side of that spectrum, HPCL and BPCL also pretty much flat. Zomato, one stock that we've been tracking this morning, JP Morgan has come out with a bullish note on it and set a target price at 340. In fact, that stock about 1.5% up. Raymond has been buzzing because of the listing of Raymond Lifestyle. That listing will take place at 10. Continues to show some spot of green in an otherwise fairly lackluster opening session at least. Sona BLW has been on our radar. Their QIP opens at a floor price of 699 rupees. That stock about 2.5% up. Linde in focus because of a high-tongue note which was maintained outperform with a target price of 8546, about an 18% upside. So Linde has been seeing a fairly decent morning. AU Small Finance Bank is another one we're watching. Slew of brokerage notes also out on them, and remember, they have applied for a universal bank license. So those are some of the stocks that are showing a bit of buzz this morning, but overall, not too many movers and shakers. I wouldn't say it's negative. It's pretty much flat, isn't it?
It's not too bad, especially given that the global markets aren't getting up to too much this morning. On the Nifty 500, there's a marginal gain, 0.3% higher after yesterday's fall. This actually doesn't look too bad. Sapphire Food is your top gainer on the Nifty 500. I'm not sure what's happening here, but the stock is up and about with a 7% up move. You also have Chola Invest that is up 3.5%. Century Textile is up about 3.5%, 4%. Chemicals are continuing to do well. So Himadri Speciality is also trading with a gain of 2.5% in trade. Craftsman Automation, Suntech Realty are some of the other big gainers as we pick up. Godfrey Phillip has another good morning. The stock trades with a gain of 2% as we see it. Auto Angs is actually doing quite well. So everything in that space is trading firm. Ecos Mobility, I highlighted this morning. The stock was up with a 32% gain yesterday. But what stood out was big hands coming in. The counter is up 8%. It's your top gainer in the markets this morning when the general market remains subdued. This one is catching attention and doing pretty well as we see it. PG Electroplast is up 4%. IFL Securities also not doing too badly in trade this morning. So you've got pockets of interest. Financials are doing well. Kernex Micro, that's another big gainer with a 4% up move in today's trade. Well, on the winning side, you've also got Fino Payments Bank, 3.5% higher. I guess it's the AU Small Finance Bank euphoria and excitement of launch applying for a universal bank license is spreading across the space. Zaggle, if I can get that one up, 2.5% higher. Prestige Estates on back of that QIP. Sona, BLW, which I think Tamanna already mentioned, are looking good. Shipbuilders having a little bit of a down day, so Garden Reach is trading slightly soft as we see it. Max Financial is down 2% as well. But Angel One, Dixon Tech are some of your other big losers. Not sure if you highlighted Kane Technologies, but we'll quickly take you through how the markets are perceiving that information that's come in this morning. A little bit of back and forth on it, but ignoring what Keynes has said in that exchange filing.
I suppose it's an official letter that they're waiting for because there was an announcement in a cabinet meeting and they are starting a plant in Gujarat.
Pen to paper. You don't want to.
I wonder what has prompted that notification.
Yes, that's still doing okay, but I think the stock of the morning is Ecos Mobility, guys. Nomura comes in. You've got a big win, 7.5%, 8% with very heavy volumes on Ecos right now as we see it.
Yeah. All right, let's get a quick view from Shrikant Chauhan and Niraj Shah on how the markets have opened up. Shrikant, I'll start with you. So no firecracker kind of an opening like the implied was indicating. You've seen sort of a muted start. So let me first get your take on the indices, the Nifty and the Bank Nifty. I'll start with Shrikant.
Yeah, I think it is as per and on the expected lines because I'm expecting market to remain in a range. I think till the announcement of this payroll comes, the data comes on the payroll on this Friday, I'm not seeing any major firework in the market. In fact, at higher levels, we need to be careful. But yes, it's an expiry day. And if we see the market is crossing 25,350, then only we can see trending activity in this market. Otherwise, I'm more on the stock specifics trend to choose for. Bank Nifty, yes, there we are seeing some momentum, but HDFC Bank is the only stock which is actually helping the Bank Nifty to trade higher. But in case if we see the Bank Nifty starts trading above the levels of 51,800, then there we can see good amount of short covering. So till the Bank Nifty is not crossing 51,800, I think we are going to see sideways activity. But broadly, I am of the view that we need to be more and more stock specific. Let the market trade around these levels. And till the markets are not crossing important levels, I think be more onto few stocks.
Okay, Nirav, any stocks that you guys have researched recently, which even at these levels you would be comfortable recommending? It was a great call that you'd given earlier on Deepak Fertilizers, I remember, fundamentally. Anything else that has caught your eye in recent times?
We've been looking at a couple of stocks, Philips Carbon Black and Himadri Specialty Chemicals. Philips Carbon Black has been traditionally in the carbon black business, but now they are entering into the specialty chemical space, performance chemicals. They've recently done an acquisition of Aquafarm for 3,800 crores. And the management is pretty confident that they will be able to grow 5 times in the next 5 years. So very, very optimistic outlook, and definitely this is a company to watch out for in the future. I think the same thing holds true in case of Himadri Specialty Chemicals. Valuations are quite attractive. So we have started looking at these two stocks in a very serious way.
So, no, sorry, I didn't get the rationale for Himadri. You're saying what?
Himadri Specialty Chemicals, I think they are also moving up the value chain. So I think the valuations in both these companies are looking quite attractive. So we've started looking at both these stocks in a very serious way.
Right. Well, that's Himadri Chemicals for you. The stock is seeing a big move of about 2% today. Nirav, did you track Ecos Mobility? And that same breath, I'm going to add Premier Energies as well and Style Bazaar tomorrow. Any of these IPOs, listings that have caught your attention for allocations?
Oh, at this point of time, the frenzy is more towards listing gains. So I think most of the retail investors are just looking at applying with a listing gains on their mind. So I think not really seen these companies in a very, very detailed manner.
Right, Shrikant, Zomato, 4% now. Brokerage upgrade came in on the counter and it's sprung up quite well. At 252, any trading strategy on Zomato?
Now it is trading above its important resistance level of 245, 247. And overall trend of the stock in last, if we see 10, 15 days, then it is in the range of 240 and 265, 270 on the higher side. So max, we can see the levels of maybe 265, 270 in the near term on the back of specific maybe reports or updates. Yes, the long-term trend of the stock is very, very strong, I'm telling you. But in the near term, I'm expecting stock to remain in a range. But as it is rebounding from the lower boundary of the range, yes, we can again see some upside up to 265 or 270. So it's a buy, but with a stop loss at 240 for short-term traders.
You know, some of the pharma companies which are seeing a good run today as well. So Piramal Pharma, Alembic, you know, still Syngene, some of them, and we're speaking about the Biosphere Act and how that could have an impact. I want to see if Biocon has held on to its gains as well after yesterday. Yeah, Biocon lost some of its gains, so it was up yesterday as well. Shrikant, your take on some of these pharma counters that have been buzzing?
Yeah, I think yes, most of the stock from the pharma space are really doing well. In fact, this particular sector is really doing much better than other indices. It is relatively doing outperforming to other space. And in that, if we go through with stocks, then stocks like Natco Pharma, Biocon, they are very close to their important resistance level. In fact, Biocon yesterday broke the level of 375, which is positive. Based on its technical formation, it is heading for 410, 415 in the near term. Natco also managed to cross the level of 1575, which is positive. And here also, I'm expecting stock to move towards 1750 or 1800 sort of levels. But for other stocks, I think there is gradual upward activity that we are seeing. And in that, we like Mankind, which is around some 2400 levels. So from here, again, the stock can move to 2500. But in the long run, yes, Mankind can also do that.
Well, thank you, Shrikant. Thank you, Nirav. It's always good to talk to both of you and get perspective on the markets. In the meantime, we'll quickly go across and we're joined by the management of Patel Engineering. Kavita Shrivakar, MD of Patel Engineering, joins in. Kavita, good morning. Thank you very much for joining us. The company has been in the news for a recent big order that you won in the hydro project space. But before I talk to you about that, our condolences. I believe Mr. Rupin Patel passed away but 2 months ago, and must have been a big shift and move. I hope things are okay.
Yeah, all things are okay. Thank you, ma'am. Thank you. See, we are a 75-year-old company. We have till now completed more than 250 projects. So it demonstrates our execution capability, and we have a strong team of engineers, all technocrats. So I think the show must go on, and we are executing the projects at full speed. Recently, we completed T14 and T15 project. It's a part of a railway. So things are fine, ma'am. Thank you so much.
Good to hear, Kavita. Yeah, hoping for and good luck, of course, going ahead as you take on the realm of the affairs. But good news has come in a few days ago. You managed to bag a big bang hydro project order. And the government's focus on this is something that's kept Patel Engineering also in the news. So lots of tie-ups, lots of activity. You want to walk us through what's going on and how is business at this stage?
See, recently you might be aware we have tie-up. We have signed MOU with RVNL. It's a PSU. So it's a first collaboration between public and private partnership to execute future hydropower projects, large value projects, and other infrastructure projects.
What is the size of this collaboration, the size of the business that you will do with RVNL, ma'am?
See, it depends on the whichever project. See, it is a collaboration. It is a joint venture. Okay, for future projects, we will bid jointly for the large hydro projects and other infrastructure projects. So it depends on the projects.
What will be the revenue share between you and RVNL? What are the sort of financials that have been worked out?
That will vary based on the project to project, ma'am.
Ma'am, but there must be some broad outline that you all have agreed upon.
It is depending on the project which we get. We will be jointly for the project.
Okay. Let me just ask you a bit about, Kavita ji, your order book. And I was looking at your order book for Q1 FY25. There's already an order book at 17,901 crore rupees. what is your outlook for the full financial year? Because your FY24 order book in totality is about 18,600 crores.
See, our order book is around 18,000 crore, 60% coming from hydro, around 21% from irrigation, and rest from other sectors. See, going forward, we see huge opportunity available in the sector where we operate in. Hydro itself, there is a potential of 133 gigawatt in India. So far, project development is around 46 gigawatt. Balance, around 90 gigawatt, there is a potential. Out of that, 30,000 megawatt projects is already announced for the bidding in near future. So we are targeting to bid in for large hydro projects, plus irrigation, plus tunneling. And we have already shortlisted, identified around 50,000 worth projects, which we are going to bid in near future.
Okay, so in this financial year, what is the number you've earmarked, Kavita ji, in terms of your order book? You're already at 18,000 crore at the end of this FY25. Where do you expect to be at?
So we expect in next year to add around 10 to 15,000 crore order book in next 1 year.
Got it. Mr. Shirvaikar, good morning. Amongst the other ideas to talk to you was also this large order win that NHPC had, wherein they have signed up for a 7,300 megawatt set of projects with Maharashtra. I'm sure if it's happening in Maharashtra, it's happening elsewhere. Now, when we had spoken to Mr. Rupen Patel at the time of your QIP, he had spoken about how you have a good market share in this field and you probably enhance it based on the strength of your balance sheet. So, one is the order book accumulation that you will get. Two is the execution that you do. What's the guidance, informal, internal assessment that you may have about what you would do in FY25 and what you're likely to do over the course of the next 2 or 3 years?
So considering our current order book, FY25, our target is to revenue increase by 10%. We'll be able to maintain the margin 14 to 15%. Going forward, as we are planning to add around 10 to 15,000 crore new orders in 1 year. So we see going forward from FY26 onwards, there will be revenue growth. We expect 15 to 20%.
Okay, so if the order book is so strong, why is it just a 10% growth number? Are there execution issues or are projects at the beginning stage because of which it's taking time, Ms. Shirvaikar?
No, it is as per schedule only. See, as last year, because of election, order book was subdued. We see now going forward, it is going to pick up. So considering that time cycle, like hydro, we have 60% where the time cycle is 4 to 5 years. Considering overall, we expect this year FY25 10% growth.
What about the PSP vertical? There's also a big push coming in from the government on PSP. And that also contributes to your top line. I know that you're optimistic on the growth numbers there. How well do you see that playing out? Any big conversations, bids that are currently underway for Patel Engineering in the PSP vertical?
The last budget, as you all are aware, last budget, government completely focused on renewable energy and development of pumped storage power projects. The Ministry of Power has already, there is a potential of 60 gigawatt, which is under survey and investigation. NHPC signed MOU for 7 gigawatt. THDC recently signed MOU for 6 gigawatt. Other private players also have shown the interest in signing MOU with the government. It is to meet the peaking power requirement. So we see huge opportunity being a hydro player there itself also. And we have already shortlisted certain projects which we are bidding in the near future.
Kavita, you also have significant project exposures in the Middle East, and historically we've noticed that because of stress in that part of the world, some of your projects have got delayed. Any concerns there? What does your international project order book look like? You want to just walk us through it and any concerns on that front?
See, right now our focus is in India. And over and above India, we are executing one project for SJVNL in Nepal. So right now our focus is in India only.
So one area that you'd love to talk about is to tell us about the debt. There were some concerns a few months ago on the fact that Patel Engineering, had a fairly high debt. But we've seen that operationally improve. You've consciously reduced and lowered your debt as we see it. Give us a sense of the debt equity and how much more debt repayment are you looking at over the course of this financial year?
As you all are aware, we are consistently reducing our debt. From peak 5,500 to we have reduced to 2,000 crore, and now our current debt is around 1,500 crore. So it is a debt equity ratio is around 0.42.
Kavita ji, just a couple of things I want to understand. So obviously a lot of focus on hydropower with various states, and you've just signed a huge set of projects. You're doing 6 PSPs with Maharashtra government. Just want to understand in terms of revenue, the state breakup. Is the focus and concentration more on some states rather than the other? Can you give us a bit of a picture there?
Hydro, our focus is, central PSUs largely.
Okay.
And some other state, like we are working for Himachal, we are working from Himachal and other state. And Maharashtra
you have
also.
A Maharashtra government pact which you've signed for 33,600 crores, right?
It's signed by THDC. THDC has signed 6 gigawatt with Maharashtra government.
Okay. Now, give me a sense of all of these orders that are coming in, Kavita ji. What is the kind of capex that you would be lining up for this going ahead? Would you need more capex coming in? Would you need to raise funds?
See, let me tell you, for hydro itself, there is 1,50,000 crore work is coming in near future for bidding. In irrigation, we see huge opportunity, around 90,000 crore work is coming up. Over and above, we see tunneling also. There is huge work in pipeline. So our current focus will be in these areas. In addition to that, we will be looking for pipeline work in some of the selected states. So overall, there is a huge opportunity. And right now, our focus is to, we are working on bidding of around 50,000 crore projects. Now, coming to the fund requirement, as you are aware, we have already raised 400 crores via QIP in current financial year only. So this will meet our working capital requirement for the project.
Ms. Shirvaikar, at least one question from my end is on how the targets for hydro have been bumped up by the government. So, would you reckon that this growth rate of between 10 to 20% is possible for the better part of the remainder of the decade, or you do not have visibility for that far out?
No, we are confident. Looking at the opportunity available in the sector, we are confident to maintain the growth of 15 to 20%.
Ms. Shirvaikar, as things stand?
Yeah, as things stand.
No, but do you think you can do it for the next 5 years, or is it only visibility for the next 3 years?
No, we can do it for next 5 years.
You can do it for next 5 years. Okay. Great. Ms. Shirvaikar, we'll leave it at that. Thank you so much for taking the time out and being with us, and all the best for the quarters and the years ahead.
Thank you so much.
That's Patel Engineering. Remember, viewers, one of the reasons why this becomes important, because Patel Engineering and some of the other companies are involved in the construction of the dams needed for hydro projects as well, and a lot of hydropower projects being given out. So it's important to talk to ancillaries who benefit out of the large constructions or large megawatts or gigawatts of hydropower capacity that is being set up. Patel Engineering saying that they'll grow between 15 to 20% for the next 5 years.
But what stood out for me is and I know Kavita didn't share details with it, but the fact that they've gone into the strategic long-term relationship with RVNL, it would be good to understand if there has been an inquiry, whether there has been a project that they've partnered with, which was supposed to be on maybe a one-off basis that's now turned into a long-term relationship. But it wouldn't surprise me if some news comes out of that front as well sooner than later. But yeah, it's unfortunate. There was a key man risk for the company, which they've successfully navigated from what we understand. Rupin Patel passed away on the 7th of July, I think a month or two after they raised 400 crores through the QIP. So significant loss to the entity, but I think markets and life
has moved on. And hydropower is big. If we have to reach 500 gigawatts by 2030, which is our stated goal, then all of these companies will definitely benefit. All right, new listing today and focus on Raymond Lifestyle. There's been a lot of buzz. Mahima, in fact, at the National Stock Exchange, has been there covering that listing, and we'll get those sets of interviews. Mahima, what is the expectation that the company has laid out? You've had the opportunity to speak to them as well.
Right, Tamanna. So, in terms of, right now, Raymond Lifestyle holds around 5% of the total, menswear market share, which is roughly 7,500 crores. And they're expecting this to grow to at least 7% by the end of FY25. And overall, in terms of revenue expectation from the wedding portfolio, they're expecting a growth of 1.5 times by FY27 and 2.3 times by FY28. In terms of EBOs, they're planning to triple their EBOs, which is exclusive brand outlets, by FY27. So their EBOs will roughly go to 800 stores by the end of FY27. Now they've also introduced, the new segments, that is sleepwear and innerwear, where they're also very bullish on. But when I spoke to Sunil Kataria, who's MD of Raymond Lifestyle, I asked him about his blended margins and the growth that is guided for. He suggests that in 4 years, his EBITDA will go to 2,000 crore from the 11,000 crore mark, which means that revenues are expected to roughly grow between 12 to 15%. And considering a 15% CAGR, the revenues will roughly be at 12,000 crores and EBITDA will be at 2,000 crores. So blended margins are expected to remain around the same levels of 16% mark, which the company currently has. And, in terms of valuations, just to give you a brief, in terms of market cap to sales, the market cap is roughly, when you compare it to the peers, it could be around 47,500 crores. And the price discovery share price could be roughly around 7,800. But if we see valuations from a PE multiple perspective as compared to the peers, the market cap, the revenues are roughly 7,900 crores. And this could probably give a PE of 30 times and price could be around 3,147. So we'll wait for the price discovery at 10 o'clock. But this is so far what we have about Raymond Lifestyle.
For that, this one's a big one. All excited and all eyes on that. Mahima, we'll come back to you very shortly when the stock lists in a few minutes from now. That's the Raymond Lifestyle counter you want to watch out for. Value unlocking, strong growth. It's going to be an exciting story that's going to play out. The group companies, remember, have been on a break, or rather on a rally in the last few days in excitement and euphoria in anticipation of this delisted entity. But I think the stock of the day that stands out this morning on the Nifty 500 is got to be Zomato. You had Swiggy's earnings out yesterday, and I think a lot of the newspapers carried how the gap between Swiggy and Zomato was reducing. But of course, I don't think that's the reason. Zomato is in the market share, and of course in terms of their earnings as well. But I think the market's excited, not about that, of course, but about the fact that it's got an upgrade and a big move this morning on Zomato. 258, 6% higher.
One, the nature of the upgrade, 208 to 340, they've of course lagged. But I think some of the points that they mentioned, that with the free cash flow generation that they've done on the business relative to the peers in the internet space, it's a big thing. And I think in this note, when I read, there's just so much of emphasis that a brokerage is now giving to Blinkit, which is a big thing. So it's been in conversation that Blinkit is now coming in. But for these guys to say that with all that they are doing, Blinkit now has the license to go out there and do more innovative things. And what they have done in NCR to emulate it in the rest of the country, it seemed to me that the whole note was about Blinkit.
Niraj, what was the target price? Did they put out a number on
340.
340, so it's still 100 rupees out from where the stock is.
No, what's interesting is, along with Zomato's run-up, look at Sapphire Foods. Maybe all things which are working for Zomato in terms of discretionary.
Sapphire on Zomato, it's a win-win for both.
Yeah, it's about just maybe eating what you feel like and not what you
Festive
need.
Festive season.
It's going on 365 days a year for Zomato, but Sapphire Foods also up today. All right, focus on auto. FADA, which is the Federation of Auto Dealers, has put out its August 24 retail data for vehicles. Just a few key points before we get to the president of FADA, Manish Raj Singhania, who's joining us on. They've said that there's a modest year-on-year growth of 2.88%, varying performance across segments. Two-wheelers have seen a growth of 6.28%, while Passenger vehicle sales have actually declined 4.53% year on year. Commercial vehicles have seen a drop of over 8.5%, and a commercial vehicle sales fall is attributed to weather-related disruptions and weak demand. But the one thing that I want to start with, Mr. Singhania, in this conversation, and welcome, great to speak with you on NDTV Profit, are the concerns that FADA has put out on inventory levels and cash flows.
So, yes, good morning, everyone. FADA has been raising the red flag in terms of inventory for the past few months. I think even though we are preparing for the festive season and the outlook looks decent for the festive season, the inventory level continues to increase on a month-to-month basis. The wholesales are always higher than the retails, and that is what is troubling the dealers quite a lot. I do hope the anticipation of October month, wherein we have the Navratra as well as the Diwali, both the festival falling in one single month, falls in place, and we do have certain inventory corrections, or else dealers would be in a bad state, holding heavy inventory after the festivals.
Manish, the fact is that OEMs have been reducing their dispatches last 2 months to deal with this inventory level. They've done it in August, they've done it in July as well. Don't you think that will ease some pressure?
So while the OEMs talk about on the year YOY dispatches, but if you look at it month-to-month dispatches compared to the retails, in fact, we have added 30,000 vehicles in stock additional in the month of July and August. So comparisons cannot be made on a YOY basis. It has to happen month on month, and the wholesale has to align with the retails. Say if a particular OEM is retailing 20,000 vehicles, and for them the dispatches is 22 or 23,000 vehicles, obviously it will add to the inventory. So that is the situation. They need to understand, realize where they stand in the market, and accordingly plan for dispatches.
Okay, so, Mr. Singhania, what is noteworthy is that when we hear from CM or we hear from OEMs, the picture is slightly different. And, when we're hearing from you, we're hearing what's happening on ground in that sense. Do you expect this inventory mismatch to ease because of festive season? Are you seeing enough, initial inquiries?
So, see, please understand, when FADA quotes an inventory of, say, two-wheeler industry, we are quoting an inventory of 15 to 20 days. Nobody questions that inventory. Or when we were quoting an inventory of 40 days for passenger car vehicles in the month of February, March, nobody questions this data. But as soon as the inventory level goes high and we are quoting this is the real situation of the industry, then why these questions arises, I fail to understand. We are tracking historical data in terms of Vahan retails and wholesales, which are declared by SAM itself. And we have concrete data on basis of data, we declare the inventory figures. So I don't see there is any doubt or questions on the inventory. It is a problem with the industry, but the OEMs should understand and take action. If the health of the dealership is not good, obviously the dealership would be in bad shape. As for the upcoming festival season, we do expect a good festival. All the things are positive, except for the rainfalls that has been, above normal by almost 16%. And if you see the rural two-wheeler sentiments, it has drastically affected the rural sentiments there. And we are seeing a sales decline from the rural sector in terms of two-wheeler retails. So that's a point that is worrying to us. For the month of September also, IMD has projected above normal rainfall. All this will not be good for the cropping season, and hence the rural economy, that is what is expected, that additional retails will be coming from the rural sector this time. If the rural economy or rural sector gets affected, then the growth will be very difficult to come by.
Mr. Singhania, I just want to understand, what is the current inventory levels you're holding for two-wheelers and for passenger vehicles?
So for passenger vehicles, it is 70 to 75 days, and two-wheelers, it is 18 to 20 days.
Okay.
Two-wheeler dealers are in fact striving for stocks. They really want few OEM dealers. They just don't have adequate stock levels to go by and are not enough prepared for the festival season.
Mr. Raj, it's also Samina joining in. There's so much of talk around the EV space. You want to tell our viewers what are the current demand trends in the EV space?
So, EV penetration, we did see some tick there, and two-wheeler has reached a penetration of almost 7% now after a long time, and we had some confusion about regarding the EMPS extension that is now in place, and we are also expecting FAME 3 rolling out. Two-wheeler, passenger car penetration continues to hover around 2%. So not much of action there, but good thing is that two-wheeler EV has started seeing some traction.
Also, have you seen any impact on sales as the government plans to roll out new emission norms? Has there been any significant noticeable impact?
Come again?
I said, with the government looking to roll out new emission norms, have you seen any impact on sales already?
Not now, not right now, no.
Are you anticipating that there could be an impact, a material impact?
New emission norms, you're talking in terms of BS7?
Yes.
So that's a long way to go away right now. And considering BS7 emission norms, the retails are not getting affected or impacted right now.
Mr. Singhania, you have also said in your note today when you put the numbers out this morning that FADA is urging banks and NBFCs to control funding to dealers with excessive inventory. Can you tell us why? Can you explain this, please?
See, whenever a dealer goes bust, the biggest loser is obviously the dealership itself. And the financing arm, whichever bank or NBFC, they have invested a hell lot of money in the dealership business, they also tend to lose. Obviously, the OEM also tend to lose because setting up a new dealership, it's a long-term process. So nobody wants a dealership going bust because of financial constraint. And due to wholesale pressure, there are sometimes pressure from the OEM to build or extend funding facility to the dealership so that the billing can happen more. What we'll be writing to banks and NBFCs that it should be the choice of the dealer to disburse the fund or extend the fund for the festive season. They should not get pressurized by the OEM and build extra or extend the limits of credit facilities to the dealer so that the dealer can additionally, already the dealer is at a very high bid of stock. Additional stock will only add with the inventory. So we want financial prudence there from the banks, from the NBFCs, as well as dealership. And we are also asking OEMs to have financial prudence so that dealer remains profitable even after the season.
Last point, Mr. Singhania, now you've talked about the festive season, you're hoping things pick up. Are there big discounts on the horizon? What are you hearing from OEMs?
So yes, see, whenever inventories are there, OEMs are also worried about the high inventory levels at the dealership. We are seeing a lot of price cuts happening in various models, and a lot of OEMs have come forward with price cuts. Discounts have increased to an all-time high. And I mean, it's a very attractive time for consumers to buy. But still, I think somewhere looking to the retail figures, consumer...
You're saying discounts have increased to all-time high. Which companies are offering which discounts?
So, I don't want to be specific, but definitely average discount is now hovering around 10% of the vehicle value.
Oh, okay, thank you so much. That is the FADA president, Manish Singhania, talking about the numbers for August. And, I always find it interesting to talk to both sides of this auto story and then get a more cohesive picture, because CM and the car companies or auto companies have a slightly different picture usually rather than the dealers on the ground. Anyway, Puneet is joining us to speak a bit about the stock of the morning, which is Zomato, on the back of that JP Morgan note. Yes, Puneet?
No, thanks to that, they've retained the overweight rating and increased their target price to roughly around 340 rupees per share. This was earlier at around 208 rupees, so a big push. And this has largely been coming from, what they are looking at in the quick commerce segment, specifically on Blinkit. Now, they have mentioned, 3 to 4 key points about the business. The first one, that Zomato is spearheading, the retail boom in the country and, the consumer transformation via its quick commerce business. They have mentioned that, the company is looking to go deeper across the metro cities. Currently, they have about 400 to 500 dark stores. This will increase to 2,000 over the next couple of years. So, big transformation as well as growth path going forward. Scale should also help monetization as well as, channel margins as well as ad spendings will be other two metrics that will be looking at to boost profitability, and as well as, incremental store economics will be better because of the large scale that they'll be able to develop. Now, they are expecting, JP Morgan is expecting that Zomato will be the lead disruptor of the modern trade segment as well as the e-commerce segment going forward, and they see that the going out business, which they've just recently acquired a part of it from Paytm as well, will be another key thing to watch out for. They've raised FY27 forecast by roughly 15 to 41% across the segments, and now see that quick commerce will form roughly 150 rupee per share value. This is up from roughly around 115% from the previous value that they thought about the company, about 50 to 60 rupees. So that's driving the valuation for the company, and they've also upgraded estimates food delivery business by 11%, which is already on a high base. So very positive note coming in on Zomato. Stock is also reacting in a very positive way as well. Back to you.
Thank you for that. That is Zomato for you. Good volume, stocks a big gainer, 6% up move on a day like today when the rest of the market is looking subdued rather. 258 on Zomato as we see it, and on back of very, very promising and aggressive buy calls coming in from brokerages. In the meantime, the markets are also in consolidation, looking okay, in the green for now, marginally in the green, but it wouldn't surprise us if the selling pressure does emerge as we go along the day, but for now, looking stable. With that, we wrap up India Market Open. Thanks for watching. Up next is Talking Point with Prateek Agrawal, MD and CEO Motilal Oswal Asset Management Company, so keep it with us.
Thanks for tuning into NDTV Profit. I'm your host, Niraj Shah. I will be tuning into Talking Point shortly. Just wanted to mark the markets for a moment and just show you what's moving and what's not. So if you can just simply pull up the BSE 500 winners and losers list, and you will see that there is very sporadic buying that has happened into stocks. So there's a Zomato which is doing well. There's strength in a PNB Housing, strength in Craftsman Auto, Linde India. So those are a few set of stocks which have actually had a good move. A few losers at that, but not too many. The point is, it's one more day of a listing. The newest lifestyle buzz maker, Raymond Lifestyle, is making its debut, and the company had demerged its consumer lifestyle business from Raymond due to create a pure play consumer brand apparel and textiles business. And the swap ratio was 4 shares of Raymond Lifestyle for every 5 shares of Raymond. And the stock, that's a big uptick there on listing for Raymond Lifestyle. The question is, can you buy it now? I'll tell you for a minute or two, for just about a moment, about whether this is worth buying or no. Remember, the company's reiterated the guidance of 12 to 15% revenue growth and of doubling EBITDA to 2,000 crores by FY28. That's about a 19% CAGR in the lifestyle business. Reduction in working capital maybe leads to free cash flow generation as well. So it's interesting. The point is, very strong listing from the base price that they've done. Can or will it see some buying? Remember, Raymond Lifestyle also reshuffled its board with a new team of 7 independent directors from across the industry and 2 internal ones. The management highlighted that all the committees will comprise of independent directors, and maybe, just maybe, to some people, the corporate governance related issue in the name are more to do with the personal life of the promoter, and people believe that those shouldn't be taken into account. I think the rate is stuck, so we'll just get this changed. But good listing. Let's see if there is more in store today. On Talking Point today, our guest is Prateek Agrawal, MD and CEO of Motilal Oswal Asset Management Company. We talked to Prateek at a point of time when the AMC has hit a cumulative AUM of over 1 lakh crores. And we talked to him at a point of time wherein, if you get the case for a chat up, you will see what really is the key thing, and which is 2 or 3 factors. Because India's weight in EMs is almost within the knocking doors or knocking on the doors of hitting the highest ever for India, of course, but more than any other country, including China. Can it pull further FPI flows, and will that turn? Further legs for defense theme, do they exist after the last 2 days of some bit of revival there? And will renewables continue to be the key power play? That and more. He's the MD and CEO of Motilal Oswal Asset Management Company. Joins us right now on the show. Prateek, good having you. Thanks for taking the time out. I hope all is well.
All is good, getting better.
Getting better, I can understand that, Prateek, because for an AMC to reach a milestone number of 1 lakh crores is pretty strong. Prateek, tell us, one, this growth obviously has come on account of this inherent belief within the Indian retail investor that the story will continue. Do you believe the story will continue?
Yes, we believe the story will continue. I think more important, if we flesh it out, if we dive a bit deeper into this, trends continue. Trends continue for many years. So, for example, 2000 to 2008 was the period of capex-driven growth. Capex intensity of the economy went up. And 8 to 2021 was a period of consumption-driven growth. And again, from 2021 onwards, we are seeing increase in capex intensity in growth. So the point is, these trends last for several years. In the new trend, we are just in 3 years. If you test the trend for various events that happened over the past quarter or so, new government coming in with the first budget and all of that, I think reason to believe that the trend of capex-driven growth continues deeper into the future.
Okay. Prateek, there were question marks around whether the new government in its avatar, wherein it's a coalition, NDA coalition government of sorts for the first time. Will there be some checks and balances on the frenzied activity of capex that was there in the second term of the NDA? You don't find any concerns around that?
We don't find any concerns around that. If you look at the budgetary maths, very clearly for various reasons, maybe fertilizer subsidies are lower, etc. But subsidy as a part of budget is going down, and capex as a part of budget and hence GDP is strong. So we think the trends continue. Even after that, whatever we are seeing on the ground in terms of new ordering, etc., has retained momentum.
Well, some bit of this is vindicated by the fact that if you look at the EM pack year to date, India is arguably maybe the only one or only large market to have given the kind of returns that India has, and which is a telltale fact of the kind of buoyancy that has come in from the domestic investor. The point is, viewers, I just want to mark before I would love to know Pratik Agarwal's view on this, because it will be lovely to know. Look at that first for currency adjusted returns. India is 15%. China, South Korea, Brazil, all of them YTD have been negative. The other bit is, because of this, India yesterday eclipsed China in the EM IMI index as the top weighted emerging market. And as per the Morgan Stanley note, India is knocking on the doors of being the largest emerging market in the MSCI EM index, the weightage rather. And that is a big deal. That's in some sense a vindication of what India has done in the last 4 or 5 years since COVID. Pratik, I would reckon, you understand this better. I would reckon there is a good side or a good case and a bad case of something like this happening. India, for far too long in the recent 12 months, 18 months, for far too long has been ignored in terms of foreign flows, despite the weightage moving up. Now that we are on the cusp of a central bank easing cycle, plus such a high weightage, do you think that draws in global flows, or do valuations become a hindrance and even passive flows will be hard to come? How does this unravel? Because to a normal mind, the normal mind would think that if the weightage is up, then at least the passive flows will be forced to come with the rate cuts.
No, so if we look at month by month FPI activity in various countries, one shall find that while in India FPIs have sometimes come, sometimes gone, but versus other countries, we have got more consistent inflows. Now, FPIs as a basket, if you think of emerging market funds, as of now are a very difficult sell. I don't think the pool of money in emerging market funds is really expanding at a fast clip. So it is, reallocation of monies that are happening. So in Feb to, I think April, May kind of a period, Chinese market moved up 30% and monies moved there, and we saw outflows. After the Chinese market consolidated, moved down a bit, things again normalized for us. So is one thought. So if you look at consistency of flows over last 1 year, over last 2 years, versus most emerging markets, India has received more consistent flows on a monthly basis. Now, if our weightage moves up, so yes, when interest rates get cut and people find emerging market risk taking more competitive versus investing in their own markets, the flows will come in. And with that, monies will get allocated globally. And if our weight is higher, we should expect to see more money coming in. Now, other markets not performing well, it's not new. If you look at from 2000 till now, the only market which has proved in some manner competitive to US returns is India. Other emerging markets, frankly, have disappointed big time. So the thought today is whether we look at emerging market pack and we look at India as a part of it, or increasingly going forward, we are ultimately now fifth largest market by market cap, bigger by number of securities listed. And sooner than later, over next 1 to 2 years, we would probably be the third largest market. Can India become an asset class in its own right? Out of the emerging market basket. Ultimately, emerging market baskets got created because every emerging market then was small. And, they needed a bigger pool of market cap, bigger pool of securities to entice global investors. Now we have become large enough in our own right. So I think the thing to watch for is, can we become an asset class by ourselves?
Okay. So, Prateek, I know it's usually difficult to time these things, and therefore I won't ask you to do that. But I just wonder if the nature of the winners, if the market were to move higher over the next 12 to 18 months, would change with the nature of the flows. Hitherto, DI flows, a lot of bottom-up ideas, banks not doing all that well, despite the weightage, etc. Does that change in the next 18 months because of the nature of the flows? If indeed the FI flows become maybe not as strong as the DI flows, but stronger relative to the past?
No, so let us look at reasons why FPIs come into an emerging market.
Sure.
It is for growth, right? Because if you are seeking value, if you want to buy cement as a business and see, how is the capacity priced, I think everywhere in the world, capacity may be priced lower than in India. So it is for growth. India as a country offers growth. Now, banks, large IT were the growth drivers last time when we got very strong FPI flows. This time around, they don't seem to be the growth leaders. Okay, the newer growth leaders is what we believe will attract the active flows. Passives, of course, will go as per the index weightages and so on. Now, in December of last year, we had one instance where, yields dropped sharply in the West and, something happened to our market. Now, in the first month of that correction happening, it is the shorts which are getting cut. Okay, so these spaces which actually may not do very well over the next period do very well because it is driven by shorts getting cut. So in the month of December, you actually saw banks and IT do very well, the large IT. And after that, they have again continued to not do as well. So I think, if the yields abroad drop and there are rate cuts in the direction gets more known, yes, flows will be there, short covering will be there. That may cause a month and a half of change in the sectors which are doing well. But if the reason is really short covering, then I think the current spaces which are the growth leaders should continue to do well.
Okay. Prateek, how are you, as such a large AUM under your belt, now investing? Because you mentioned that FPIs come for growth. I'm guessing you are investing for growth as well. But if anybody who's investing in growth for the last 12 months in financials, for example, hasn't quite made money, right? So therefore, do you take a contra view and not be as high or be much lower than the benchmark weightage, let's say on banks? I'm not including the whole financials because AMCs, brokerages have done well. It is banks which are sulking, particularly private banks. How do you think of this as such a large AUM? How do you kind of navigate through this?
No, our AUM is not large, we are very small. So 1 lakh is the total AUM. On the mutual fund side, it may be just 50,000 crore. On the AIF PMS side, 27,000 crore, and the rest of it is passive. But yeah, that said, we are out and out growth investors. QGLP is the philosophy that we follow. we put a threshold that, any space that we want to be in, and this is a team effort, should present on the space itself growth opportunities 2-3% higher than what the index will deliver over the next 3 to 5 years. And today, if you see our portfolios as a house, we would be seriously underweighted, practically not present in staples, practically not present in large cap IT, very little into banks. And this has been the position for last 1.5 years. We have gradually reduced it. The money is taken from there. So banks and IT is 50% of the index. Has gone to, yes, some mid and small cap IT names, but more to new tech, to spaces like renewables, spaces like electronic manufacturing, luxury consumption, etc., where the growth orientation is expected to be very high and in line with what we want to deliver to investors. So we are out and out growth investors. To our mind, we run some of the highest growth in earnings portfolios in the country. So yes, while we don't have banks, we do have some amount of insurance, we do have some amount of capital market presence in our portfolios. We have one more space that we have is defense. We continue to remain positive on these spaces.
Got it. The other, Prateek, is the need for new paper to come in as the market broadens and more flow sticks in. So we've seen the new age companies do really well, right? I mean, Zomato may be up 6% today on a JP Morgan note. But the thesis that, let's say, JP Morgan is putting out for Zomato or some other houses have put in for some of the other stocks is alive and kicking. What's your sense of these new sectors getting created? We also now have an electric vehicle company listed, and there is more coming. So what's your sense of the new age sectors getting formed? Are you constructive here?
Very constructive. We may not own all of it, but we are very constructive. In fact, this is part of our thesis. We say this is time for alpha, and this is a theme that we have covered for last several months. Just like, if I give you a similar situation that happened in the past, just like software as a sector came into being in mid-90s and, delivered huge alphas to managers over mid-90s to 2000 kind of a period. Look at the construct new space, not there in the index, large quantum of growth in earnings and 5-6 years of earnings growth on the trot. Delivered large alphas. In the similar manner, newer spaces like electric vehicle, electronic manufacturing, renewable, defense, new tech, etc., are doing the same over the last 3 to 4 years. And the runway of growth continues to be long and in many cases getting stronger. So we are very glued, very positive on newer age businesses.
Got it. Okay. So very positive there, Prateek. The other thing is sectors that have done really well in the last couple of years and now are starting to take a bit of a breather. I mean, defense may be up in the last couple of days, but otherwise has now kind of cooled off from the frenzy that it was in. You guys have a defense fund as well, if I'm not wrong. How do you think about the story here when the common narrative is that yes, there is an order book, yes, there is execution, yes, there is indigenization, but the multiples are extremely stretched. So how do you think about it? Please explain.
So we have a passive offering on the defense side. Like I said, we are the largest passive strategy house in the country. We continue to be positive defense. I said that as a part of my earlier comment. To us, the current pause in the market is like a pit stop. Sometimes the narratives become very strong. Maybe valuations go a tad ahead of, or maybe let's say they rise so quickly that people get uncomfortable, and there can be a period of cool off. But really speaking, we believe this is a space where 15 to 20% growth on sales should be delivered, and with a higher growth in profits, and for a very long period of time. So we continue to remain pretty positive there. If you look at our active portfolios, practically all active portfolios, one should expect to find a defense name or two.
Okay. Okay. And Prateek, last couple of questions before we let you go. The other thing is, much like defense, is power, right? And power across the space. And I don't even think the finances may be expensive. But be that as it may, multiple ways to play: ancillaries, hydro, thermal, green, what have you. And the sector has rallied, but the targets are very stiff. So is that also in line with the thesis that maybe there is a bit of a pause and the rally could continue? How do you look at power when you look at that very wide bucket?
Yeah, so let's say energy intensity of the economy stays the same. Actually, if we increase manufacturing as a part of GDP, energy intensity should be expected to increase. It shall increase also because, as per capita rise, people will opt for more air conditioning. And last summers, you saw air conditioners not being available at all. The shops were all emptied. So electricity consumption should be expected to grow stronger than usual into the future. Now, earlier there were other sources of energy, coal, oil, gas, etc. Now, as we become more green, a lot of this will get substituted by electric power. So, if we have, for example, all the two-wheelers and the cars increasingly electric, you need less of other fuels, you need more of electricity. So electricity demand would be higher on that count as well. Here, I think a good, nice way of playing is through new energy plays in solar and wind. There the runway of growth is long, and I think valuations don't capture it all because the start was very skeptical. How long will it continue? Single-use plants, what if it runs out? But the thing is, now there is no going back. Increasingly, if you look at FDRE bids, they're competitive. They're getting more and more competitive to thermal, which means future is all going to be renewables. So, or mostly going to be renewables. So I think that is one way of playing it. The second way is, of course, to look at stuff that goes into, suppose one is not sure whether coal does well or wind does well or solar does well. Get into stuff which goes everywhere, something like cables, etc. So it's the other thought that we have, control stations, etc. And that is what we have in our portfolio. But in these spaces, again, the longevity of growth is definitely there. Overall growth will be 7-8%, so that is significantly below the threshold we want. But in newer spaces, solar, wind, etc., even pump storage, growth can be an order different, and that is where our interest lies.
Got it. By the way, as we speak, the rupee has hit a record low of 83.99. Now, is this the storm before the calm? Usually it's the calm before the storm. But will we start to see the rupee strengthen at some point of time in the near future? Or do we continue to be weak? I mean, with crude falling, CAD improving, flows likely, rate cuts on the anvil. Prateek, a macro question to wrap up this conversation. A word on the rupee and what could happen ahead, and if there are investing implications on the same.
Yeah, so theoretically, with rising forex and everything that you spoke of happening, which is again positive for forex accretion, rupee should strengthen, meaning from close to 84, it should be closer to 83 or lower. But point is, forex is just one bit of the equation. Competitive intensity is another. If we look around us and we compete with our neighbors in various goods, neighbors such as Pakistan, Bangladesh, China on various items, and if their currencies are not strong, their currencies are weak, to some extent it becomes difficult to retain our levels with the dollar as well. I think that is what is happening, because otherwise our forex are at a high every week, every month. We keep accruing forex. We have gotten included in JPM bond indices, so those flows are happening. We may get included in Bloomberg bond indices. More flows will come and so on. But I think it is this competitive thing which is keeping the rupee weaker than where one would believe it should be. Now, weaker rupee is good for corporate profits. IT get tailwinded. Every manufacturing which competes with imports, gets that much more protection and so on. So, depreciating rupee is good for profits. What is good for profits is good for the direction of the market. In the past, when currency depreciated, markets fell, because FPIs were a large part of our market activity, and in the thought of protecting dollar returns, you saw rupee weakening also coinciding with a lot of FPI selling. But now, since FPIs are a marginal part of the overall ecosystem, it is our money which reflects our fundamentals and markets. I think small rupee depreciation should be taken as a positive for market rather than negative, because it is positive profits.
Got it. Prateek Agrawal, always a pleasure talking to you. Thanks so much for taking the time out. You may be small in your eyes, but this is a great milestone. Wish you all the best for many more.
Thank you. Lovely to be here.
Yep. Lovely to have you. By the way, as we wrap up, just keep in mind a pocket that is doing really well, something that we highlighted yesterday as well. Pharmaceuticals. Maybe it's the Biosecure Act, but some of the pharma names are really pumped up in trade. So watch out for a Newland, a Laurus, and a few others. Might be some pretty strong moves there. There on your screen. Laurus, Biocon, Mankind Pharma, Ipca Labs, very, very active. Well, new boy on the Dalal Street. Raymond Lifestyle is very active too. Lists at a strong premium. My colleague Mahima caught up with the managing director Gautam Singhania at the listing ceremony today. Listen into his plans for the future of the company.
I think it's great. I mean, you said yourself is 99% up, and I think that's good. And from here, the only way is up. So we are focused on creating shareholder value, which is what we have said. And this is a one step in that direction.
Absolutely. And you now have three companies under the Raymond Group. What are the kind of growth levers that you're expecting? How are you planning to stand out in all of these three businesses?
Well, each one has its own strategy, but eventually what creates shareholder value is what we're looking at.
Absolutely. And one last question. Raymond Lifestyle has always been about the complete man. Do you plan to also foray into the women wear business?
We've completely stated we're not getting into the women's wear business.